Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, Fed Chair Jay Powell spoke today in Jackson Hole, Wyoming, what's known as the Woodstock for bankers, about future interest rates. And when he speaks, the markets listen. So just what did he say? Last week, we talked with former CEO of ESPN, Steve Bornstein, about people cutting the TV cord and increasing streaming. Well, ESPN is now in talks to partner with a major company. We'll tell you who. And the stock market this week ended up for the day. So what will the rest of 2023 look like for your money? Tonight, we're going to be talking with Darryl Cronk. Darryl is the president of Wells Fargo Investment Institute and the chief investment officer of Wells Fargo Investments. Are we looking at more bank failures and higher interest rates? Where is he telling his clients at Wells Fargo to invest? We'll ask him. I'm Andre Laborde. We've got these stories and more. Because it's Friday and it's time for Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. It's Friday, August the 25th. First up, Jackson Hole, Wyoming. It's a far cry away from New York City or Washington, D.C., but this get-together annually by the Federal Reserve officials and bankers and such, it's sort of like a Woodstock for bankers. Last year, Chairman Jay Powell, word sent the markets heading south with his statements of continuing increases of interest rates. Well, this year, he was a little more measured and he was cautious about his words. And this week, the most anticipated stock revenues were released this week on a stock many people probably had never heard of. The stock is called NVIDIA. Now, why is it so special? Because it's viewed as a bellwether for artificial intelligence. In fact, you could even say it puts the intelligence in artificial intelligence. Other companies such as AMD and Intel will be coming out with a graphic chip to try and rival NVIDIA. But NVIDIA is clearly the leader. And NVIDIA doing all the research and designs and by far way ahead of all others in the technology of AI. NVIDIA makes the gaming graphic chip that is used and will be used to make AI or artificial intelligence work. And if you own an ETF, exchange-traded fund, you may already own it because there are 443 ETF and mutual funds that now own this one stock. So how did our money do this week? Well, all the stock indexes ended positive for the week, but the Dow Jones ended negative for the second week in a row, with United Health, J&J, and Nike dragging it down. And the NASDAQ and the S&P 500, they broke a three-week losing streak with technology, discretionary, and communication services. They were the top sectors for the week. And also this week, the Dow Jones closed down this week at 0.4 of a point for the week. The S&P 500, they closed up at 0.8 of a point for the week. And the NASDAQ, they closed up this week at just over 2% for the week. And last week, we told you how for the first time, traditional television watching was under 50%, and streaming has taken over on how you look at normal television, well, like shows like us. Well, this week, Amazon is in talks with Disney, owner of ESPN, about a streaming partnership. Now, it would be that Amazon would not buy ESPN from Disney, but a partnership. So last week, we did mention how Dan Ives, tech analyst from Wedbush, said it's not a matter of if Apple TV buys ESPN, but when will they be buying it. Amazon TV is a competitor of Apple TV, and possibly Amazon, just maybe trying to cut Apple TV off of the knees and trying to buy a sports property as big like ESPN so that Apple just can't acquire it. And if you're like most, inflation is the tax that continues to eat up your savings. According to an Ipsos poll, 80% of those surveyed said they're spending more on groceries and gas than they did last year. Well, the thought of buying a house or selling the one you're in now and moving to a new one will now cost you an interest just under 7.5%, which is now at a 22-year high. And 61% of Americans say they're now living paycheck to paycheck. According to a new poll of over 1,000 registered voters, 30% approve of the way President Biden is handling inflation, and almost 70% disapprove. So joining me tonight to talk about inflation, the Federal Reserve raising of interest rates higher, and are we due a recession, and if so, how to invest for the remainder of the year and more into 2024, is the president of Wells Fargo Investment Institute and the chief investment officer at Wells Fargo Investment Management, Darryl Crunk. Hi, Darryl. Welcome to Wall Street Wrap-Up.
Thanks, Andre. It's great to be here.
You know, normally August and September are probably the two worst months of the year for stocks. Last week, we did great. This week, with NVIDIA's earnings and with others, what became the unmagnificent seven is now becoming back again the magnificent seven and such. What do you think? Do you see that for the rest of this month and possibly into September, are we looking at good times ahead for the stock market?
Well, certainly the NVIDIA earnings earlier this week were a big bolster to what has been some recent weakness. We've actually violated on the downside, Andre, some of the technical support levels, the 20-day, the 50-day moving averages on the NASDAQ and on the S&P. So it looked like in the month of August and September, we were well on our way to kind of that 7 to 10% correction. We'd crested down about 4 or 5%, but you're correct in saying we joke in our strategy committee that August, September, and October are kind of murderer's row from a seasonality standpoint for markets. They just have always had a difficult time in those months. So navigating the next, let's call it 2.5 or 2 months, will be important for markets.
Well, there's a lot of cash on the sidelines right now. Do you think that stock investors are knowing, like these murderous months of the August, September, October months, that they're waiting? That normally there's a FOMO, a fear of missing out, but in this case that there's not? What are your thoughts?
Yeah, I mean, if you look at money market fund balances, they're at record all-time highs. Part of that is just grabbing that yield that we haven't enjoyed since actually pre-financial crisis. We're getting paid on the short side of the interest rate curve or in money funds, the highest interest rates we've seen since probably 2006, 2007. So that's appealing. And actually, it does decrease some of that FOMO, of fear of missing out, because now you're actually getting paid to sit in cash, whereas a few years ago in a zero interest rate environment, you weren't. The question is how much of that money ultimately comes back into the stock market. So I'm not sure that there's going to be tons of money coming back into the market, and it will really depend on how strong the consumer remains. There's already some early signs in some of the credit card data and the auto loan data that the consumer is starting to weaken here a little bit. And we know the consumer is 68% of GDP. So if the consumer weakens, that'll be a problem for the economy.
I understand exactly what you mean, because I'm curious with the 10-year treasuries paying a huge 4.3, 4.4%, a huge high number. Will people just be feeling more safer into even a 10-year treasury rather than into an equity either fund or a specific stock?
Yeah, it's a really good point, because for the longest time, a nice blue chip equity was giving you a 2, 3, maybe 4% dividend, right? Mm-hmm. And that was better than what you could get anywhere on the yield curve, short-term or long-term rates. Now, of course, short-term rates are higher than long-term rates. We have what's called an inverted yield curve when that happens, which is usually and historically an ominous sign of slower growth or more challenging growth to come. We'll see. But investors can now enjoy upper 4s to 5%. Earlier this week, the 2-year treasury was at 5%. So there's a lot of cash being put to work there. We're telling investors to what we call barbell their portfolio, which means own some of the short side and take advantage of those highest yields on the board, but also own some of the long side. And why do you own the long side? Well, because if the economy slows and if we were to enter a recession, long-term rates will fall faster than short-term rates. And so what will happen is you'll get a greater return there. So it's a little bit of a hedge, if you will, against this idea that the economy may drop into recession either later this year or early next year.
Normally, a 30-year, a 10-year, or a 30-year bond would pay more than maybe, say, a 2-year bond, but with an inversion curve, you're getting more from a short term. Do you think that because there is still an inversion of a 2-year paying more than, say, a 30, do you think that that would be ominous as of a recession, maybe not, maybe in the end of this year, maybe in 2024?
Yeah, I think so. Look, there's been a lot of discussion about recession for the last, let's call it 12, 18 months, right?
Mhm.
Where people have been predicting it, they've been talking about it. The running joke is that this is the most predicted but never realized recession on the history books, right?
Uh-huh.
The reality is the yield curve is inverted fairly steeply, the most inverted we've seen since the late 70s, early 1980s. And just to give you a little bit of history, the last two times we've seen a major economic recession, so you would go back to the yield curve inverted in 2006 and in 1999, basically. And it took 18 months from the time of inversion to when the economy dropped into recession. So this time, the yield curve inverted in July of last year. So if we say August or September of this year, we're not at that 18-month period. We'd be at that 18-month period around year end if the historical relationship holds between when the yield curve inverts and when the economy kind of slows and dips into recession. So that's all to say, we still think the base case is a recession. We think it's a mild to moderate recession. We don't see it as a deep recession, and it's likely probably the first half of 2024.
Do you see that Jay Powell and the rest of the Fed governors will increase raising rates a little bit more? Or do you see that because of what you're saying that they may hold or even possibly even lower?
Yeah, I would tell you this. The market commentary is all over the board. And in fact, earlier this year, the bond market had talked itself into numerous cuts of interest rates or reductions of interest rates coming late this year. And we never believed that. We always thought that was an inaccurate prediction. It's in fact now kind of gotten built out of the bond market expectations. Nobody believes the Fed's going to cut interest rates in 2023. There are still projections for cuts in 2024. But probably the more immediate conversation, Andre, is about is the Fed going to hike again, right? Or are they done with their last hike in the month of July? I doubt they increase in September. We think they may stand pat in the month of September, and then there is no meeting in October. But we think it's likely they probably increase again in November. So another increase this year. Of course, it'll be data dependent on how fast inflation comes down, but I'm not sure they've slayed the inflation beast yet, quite frankly.
The CPI, we're right now at about 3%, give or take at this moment. So do you
Yep.
think that he'll want to be consistent and still stay at that 2%? Do you think he'll edge up at 2.5 or closer to 3, or he doesn't want to spook the markets any?
So if you actually take Jay Powell at his word, right, and go back and pull his statements, his commentary, he's made no bones about the fact that 2%, 2 to 2.5% is where they want to be, right? The market continues to believe that they may eventually cede ground and allow that inflation to settle at a higher rate. We don't think so. We take Chair Powell at his word that he's going to push inflation down to where it is. You're exactly right, Andre, that a year ago in the summer in 2022, we crested consumer price inflation or CPI at 9%. We've dropped it all the way down to 3. So again, think about that comment about quick rise, quick fall. We've had the quick fall. It's going to consolidate for a while, and we think go higher again. And what's interesting is if you look at the drivers of inflation and you say in the back half of this year, will inflation start to creep back higher or will it go down? I have to look no further than what's going on with oil prices at $80 a barrel. A year ago, they were at 70, so they're higher today than they were last year at this time. Wage pressure continues to go higher. Wages, depending on the measure you want to use, are still growing at 4 or 5%. And the housing market and what's embedded, which are rents or real estate, have been surprisingly very strong. I think stronger than most expect. So just the components of inflation are all telling you in the back half of this year, inflation is likely to drift higher, not lower. And that's going to be a problem for the Fed. They're not going to like that. They're going to want to stay on their path of fighting inflation and probably raising interest rates, in our opinion.
With interest rates for housing the way they are, many people are thinking, well, wait, if I'm paying a 2.5 to 3% mortgage, on my 30-year mortgage, why do I want to sell my house now and get into maybe a 7% or more, depending on their credit rating? So would I assume correctly that the housing market has been, I know it has been slowing, and it will probably get slower, but would stocks in sectors such as home builders or maybe other types of sectors as that for new homes, would that not be something that an investor may want to stay away from, but maybe let's say sectors such as Home Depot, Lowe's, or remodeling the present home you already have, may be something you may want to look at?
Be careful, Andre. We may hire you as an analyst here. I think you nailed that right spot on. So we do think home builders are probably a little overextended here, and we do think you can probably own some of the, the home improvement type companies. And if you think about it, the housing market is really so it's different than it was in past cycles. So go back to the 2006, 2007 cycle where everybody wanted to own a second home and a third home, and that drove the housing market. There was a huge amount of leverage embedded in that system because everybody was borrowing on a second mortgage or a home equity line of credit. That's not the case today, right? Any strength in the housing market has come because of a dearth of supply. We haven't built enough new homes in this country, basically since the global financial crisis, or enough to keep up with population growth. So there's not enough availability out there. And if you couple that with exactly the point you just made, which is if I have a 2.5% mortgage, why do I want to sell my existing home, go find another one, and take out a new mortgage at 7.5%? I don't. And actually, if you look at the numbers, out of only 14 homes out of every 1,000 homes in this country have turned over in 2023, which is an incredibly low number by historical accounts. So it's telling you people are staying put. They're not moving anywhere. They're not going anywhere. The good news is there's not the leverage in the system that there's been in past housing crises, but there just is no available supply out there. So that's kind of backstopping prices and holding prices more firm than they normally would be at this point of the economic cycle.
Most if you have a homeowner, majority, not all, they go through small regional banks. Large banks as well, too, but as well commercial real estate loans. Well, as we were talking before about interest rates on Treasury bonds, and I'm thinking of banks such as SVB, Silicon Valley Bank, or others that may have wanted to invest in a wise manner, but they got caught in those Treasury bonds with going long term when they should have gone short. And maybe as a possibility, are there more regional and small banks to have problems, but now banks have to keep more cash in reserve, so their standards may go higher?
Yeah, I think that's right, Andre. We've never even believed. So the narrative was such that let's admit that in March, the events of the small, medium-sized banking crisis kind of snuck up on the world, right? Because nobody realized some of the interest rate exposure and what was going on there. We're not quite as convinced, and frankly, you're seeing a growing majority coming to our side because recently Moody's just downgraded 10 U.S. small, medium-sized banks. Fitch has put a bunch others on the watch. S&P did as well recently. And if you think about why, the headwinds of increasing capital requirements that are going to be required by regulators, meaning you got to hold more capital than they historically have been made to do, to make sure they can backstop any losses in that bond portfolio you referenced, along with the higher cost of funding. As interest rates go up, the cost of funding for banks, if you're not funding it via savings and checking accounts, goes higher. So that shrinks net interest margins. And then if the economy does slow, you're going to see rising loan losses. They're all three of those. Increasing capital requirements, higher cost of funding, and rising loan losses are going to challenge the business models of those small, medium-sized regional banks. So we're not convinced you're fully through the woods yet, and we would be a little cautious on this sector right now.
Do you see that with the problems that we've just been discussing, that the Christmas season, so many retail companies figure as Christmas as their largest percentage of time to sell their goods and services? What do you think this type of holiday season may be in 2023?
So our high frequency fingers on the pulse for the consumer would probably go first to students back to school spending, which has been actually, I think, surprising and better than most expected. So the consumer's holding up well. That's a function of Wage growth has been stronger. The consumer has had those, cash reserves and balances to fall back on. But again, if history is any guide in a cycle, what happens is the consumer has their savings that they kind of exhaust first or go through, which is then followed by they start to put things on the credit card. And we've seen total outstandings of credit cards rise. You just recently saw, over $1 trillion for the first time in credit card outstandings. And then eventually that kind of comes to a stop because the consumer can't put anything more on the credit card. And that's when you start to see rising delinquencies and defaults. So we're starting to see that third leg move a little higher. It's coming from a very low base, admittedly, but it's directionally starting to move higher. We think by the time you get to Christmas, right, and the December holidays, it's probably going to slow some of that spending. I don't think it'll be a hugely disappointing season, but I don't know that we will blow the doors off and set a bunch of records. It really depends on two things, we think. Number one is, does wage growth remain strong? Because if wage growth remains strong, consumers have dollars in their pocket to spend. And does the labor market remain strong without layoffs and unemployment, right? Because if you have money in your pocket and you believe you still have a job or feel good about your job prospects, then historically the consumer will spend, and that bodes well for the holiday season.
You were talking about students are now going back to school. What about now there's a change since before COVID, which was March of 2020, college students who had college debt are now going to have to be repaying that college debt that's been suspended. That money will instead of being put into the economy will now be used to be paying on their college debt?
Yeah, it's a conversation that's been had a lot lately, I would tell you, Andre. And I would say this. So when you think about what's going on with student loans, so interest on student loans after a 3.5-year moratorium will start back up on September 1, and then payments will resume on October 1. It's going to impact about 26 million borrowers who have federal student loans in forbearance totaling about $1.1 trillion. So if all the borrowers that previously weren't making payments restart payments of, let's say, $200 to $300 a month, that's about $5 to $6 to $7 billion of interest payments that weren't happening before. So how do you gauge how much that is economically or what that means for the economy? It probably means about 0.5% off of disposable income. And disposable income is the strength of the consumer. Again, do they have money in the pocket to spend? But it's not a small dollar amount, and it matters quite a bit. So I think you have to watch it, and we've put it in our models as we've thought about what we talked about earlier, which is kind of that slowdown towards the end of this year and maybe a recession early into 2024.
China right now has been having a problem economically. Their economy is down, and their youth, especially their youth unemployment, is up. And at one time, when China was having such a problem with supply chains and such, there would be a greater movement, I would think, in the stock market. Do you think the stock market has already placed in the problems of China?
When you look at China's growth, about any way you slice and dice it right now, it's weak, and it's weaker than most expected. And I think earlier this year, there was a lot of anticipation about, as China's economy reopened post-COVID and workers started going back, you'd see a resurgence both in economic activity, and then also there was an assumption or an estimate that China would be infusing much more stimulus back into their own economy. Neither have happened up to this point, and so the growth has been unexpectedly weak there. I think the stock market has kind of rolled with it, right? If you look at China, they're by all accounts weaker than expected. If I look at a number of other places around the world, like Germany, they're unquestionably in a recession right now, and certain parts of Europe are as well. So the question becomes, can the U.S. become an island unto itself economically in the global sea, if you will? So I do think it will start to lead on growth later this year as people realize the extent of the weakness that's coming out of China. Now, the narrative up to this point, Andre, has been that weakness has been disinflationary, and so it's pushing disinflation back to places like the United States, which is helping us as we fight inflation, right? So it's kind of bad news is good news type of story. But at some point, that bad news becomes just outright bad news. It's slower growth for the second largest economy on the planet. And I think we just have to take that into account, and we'll have to take that into earnings estimates account as we go, because it does matter for earnings.
Daryl, what's the best piece of investment advice were you ever given?
Oh boy. So here's a piece of advice my mentor gave me a long time ago, Andre, and I've always tried to live it, and I proclaim it as often as I can to my strategy team, probably to their nauseating state, right? Which is which is the best advice is only the advice that can be, number one, understood, and number two, implemented, right? And it sounds basic, but too many in our industry, talk in jargon, they talk at a level or they write at a level that, the average person probably can't discern or understand if you're not living in Wall Street, vernacular every day and really deep in the markets. And so I think, the best thing I always try to implore on my people is, look, advice is only as good as what can be understood by people and then ultimately implemented. And the second piece is important too, because sometimes people are just espousing opinions, or as they like to say in our business, talking heads. So if there's nothing that's a so what can I do about it? What should I do about it? Then it's probably not really great advice.
Daryl, I think simplicity is great advice. I sure appreciate you coming.
My pleasure, Andre. Thank you for having me.
Thanks a lot, Daryl. Hey, if you have a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benacapital.com. So let's take a look at the markets heading into next week. But before we do that, what writing device was patented on this day in 1843? We've got the answer, and it's coming up. So what writing device was patented on this day in 1843? The typewriter. So let's have a wrap up on Wall Street. If you still receive your movies from Netflix by DVD in the mail, well, it's coming to an end. Netflix, after 25 years of sending DVDs, is ending the mailing as of October 27th. But some Netflix subscribers are going to be receiving up to 10 extra movies as the service winds down. It's the end of an era. And Subway, where many of you may getting your foot-long sandwiches for lunch or dinner, is being bought by a company that I'll bet many of you have never heard from. It's a private equity firm called Rourke Capital from Atlanta, Georgia. It's buying Subway for $9 billion under their Inspire brands, already owners of Baskin-Robbins and Jimmy John's and Dunkin' Donuts and even Buffalo Wild Wings. And that's our show for Friday, August 25th. Our thanks so much to Daryl Cronk for being with us tonight. But as always, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll see you next week. And remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde. And always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.